Welcome to Sell Your Business, Buy Your Freedom, featuring Ronald Coleman. I'm Anthony Kapkin, editor of Electrical Business Magazine, and I'll be moderating today's presentation. The short worksheet that was emailed to you will help you keep your thoughts organized throughout. If you didn't download it, you should see it in your control panel on the right-hand side of your screen. You can download it and print it out again. It'll just help you get through the presentation, but it won't make or break the presentation. Now we have scheduled about 10 minutes at the end of Ron's presentation for the question, so just type them into the dialog box that you see on the right hand of the screen, and I will read them to Ron at the end and he will answer for the whole group. Now we may not get to everyone's questions, so we do encourage you to follow up with Ron directly afterward if there's some more information that you need. Now you've read Ron's biography online, so the only thing that I would like to add before passing the podium over to him is this. I've known Ron and worked with him for about a decade, give or take, and he knows his stuff. He's worked with numerous contractors over the years, both successful ones and failures, and he's passionate about sharing the lessons he's learned with you so that you can end up in the successful category. And with that, I present Ronald Coleman.
Thank you very much, Anthony. That's pretty good. And like my mantra is more money, more fun. So I think that's one of the things that's important for all of us, not to get too serious about things, but to stay on track and make our businesses successful. And as you said, the heading today is Sell Your Business, Buy Your Freedom. And it's kind of simple in that regard, but it's not nearly as easy to do as we would maybe think it is. And many of us suffer from what we call the FTI disease. It's a dreadful disease that a lot of us get. And FTI stands for failure to implement. And that's the problem, is we end up with lots of good ideas, but we don't implement them. And at the end of the session today, we're going to spend a couple of minutes asking you to write down some actions that you're going to take because you've been on the presentation, because without action, there is no change. So we don't want you to be wasting your time. We want you to get pretty solid outcomes from the presentation. So hopefully you will not be one of the people suffering from that FTI disease. So the sort of topics we're going to cover off. My PowerPoint has blocked, Anthony. There we go, sorry. We'll talk a bit about the state of the construction industry. We're going to talk about, are you exit ready, meaning you as the owner of the company as distinct from your business exit ready, because they're two separate things we need to look at. We'll talk a bit about your corporate structure. We won't get into too much detail on that because that can get a little bit heavy, and you also need to discuss that with your own financial advisors. And we will touch on whether you should sell assets or shares and the pros and cons. There's no right or wrong answer. It can work either way. And this is probably the most difficult and the most important part of getting your business ready for sale, and that is to fire yourself. And we'll also talk about that and some other strategies that will help you get to the next level. And as I said, we'll end up doing your plan of action. If you were to think about your business from the perspective that you're in business to sell it for the most amount of money possible. I don't know when you want to sell it, but from day one you're thinking that I'm in business to sell it. If you keep thinking like that, it's amazing what you will do to make your business more successful. That should be your guiding principle and the question you ask yourself every day, am I getting the business ready for sale? So this is some background on the industry. The British Columbia Construction Association in 2012 did a survey among contractors throughout the province of BC. And here's some of the results that came out of this survey. And as you'll see, the majority of contractors are 50 years of age plus. They've been in business 16 years. And surprisingly enough, smaller contractors average from 11 down in employees. So we're not looking at big companies in the majority of cases. And again, 35% want that out in 5 years, another 30% out in the ensuing 5 years. So again, we have the majority of them wanting to exit their business within 10 years, which is putting quite a lot of pressure on the sale of businesses. And where are those businesses going to go to? Just under a quarter said they'd sell to family, 2/3 would sell to non-family, which could be to employees or to competitors or whoever else, and 10% are going to die behind their desks. So we're not sure what's going to happen with those ones. Then they were asked about the value of the businesses, and 14% thought, well, we could get between $300,000 and $500,000 for our businesses. 56% think their businesses are worth more than $500,000, and I have grave reservations about that because we tend to get very emotional when it comes to putting a value on our business and where it's going to be. Only 3% had actually got a formal plan, but at least 41%, they did have an informal plan. They had a fairly good idea of what they were going to do. But there you go, 56%, no plan. And most of these people went out within 5 or 10 years, and they have no plan for getting out of business. About 1/3 of them took advice from their accountants. And here's the reason why Electrical Business and Anthony decided that they should put on this webinar. 72% of the people want more help. They want more guidance, more advice, and therefore this is what we have here, and this is why I wrote a book called Exit Ready, and this is why I was so keen to put on this presentation so that we can get this moving forward and give people an opportunity to do better. This is a scary statistic that wasn't part of that survey, and I've seen it in other areas, and that is that 80% of listed businesses will not sell. Why? Because they're not worth very much, and because there are far more sellers and far fewer buyers. So it's a really, really tough situation, and it is going to get worse, and we think it's going to peak in about 2018, because that's when a lot more businesses are going to start coming on the market. So if you are a buyer, you want to buy a business, you have a lot of choice out there, and obviously you're going to pick the one that fits you the best. And we'll talk a little bit how to make your business the right business for people to choose. But that's kind of a scary thing, is to be looking at those stats and see how unprepared we are for getting to the next level. So on page 1 of your worksheet, I've asked a few questions about, are you exit ready? And the questions are quite straightforward. When I sell my business, I want X amount of dollars after tax. So whether it's an asset share sale or a share sale, it's the after-tax figure we're talking about. Now, what's my business worth? And if there's a gap, am I going to bridge the gap? Am I going to lower my expectations? We need to think more about that so that we have a goal that we want to achieve, and we need to be able to set steps to make that happen, because otherwise the day comes along and we've made no provisions and we're not going to get anything like we want, and with 80% of business not selling, we end up closing down the business. So the next thing is, and when I'm helping companies sell, I always ask the owner, what's in your future and what will you do when the business is sold? So, what is going to happen? Are you going to stay work in the company for the new owners? Are you going to stay there for a transition period? Are you going to spend more time with your family? Do renovations, learn language, a whole host of things that you could be doing. But you need to have a fairly idea, because if you don't, when it comes to signing on the dotted line, you have to take this leap of faith. And you won't take the leap of faith because you have nothing positive to be looking forward to. So I really think you have to get your own mindset in place before you can start thinking about the business mindset. And if your own mindset is in place, I honestly believe you'll do better at making your business exit ready. But make yourself exit ready first, and then focus on making the business exit ready. Okay? So to make your business exit ready, I've put into 2 little sections. The first one is, there are a number of questions, I think it's about 11 questions there, about, is your business exit ready? And I'm not going to go through them all, just browse through them as we're chatting here. But the first one is are you making more than 5% pre-tax profit? After all expenses, after normal salary for you, are you making more than 5% profit? If you're not, you're below average and nobody's going to want to buy you. You have to be a successful company, otherwise, well, if somebody does buy you, they'll give you peanuts for it. If you want to make any decent money, you should be making 7, 8, 10, even 12% pre-tax. And I have some contractors making up to 20% pre-tax. They tend to be smaller service contractors with sales up to usually under 2-3 million. So look at those questions there. They're all kind of yes/no questions, and see how many of them are yes, how many of them are no, and this should give you some guidance as to what you could be doing to make your business more exit ready. And look at the ones that are most important to you and start prepping them. The second part of this is I've got these critical factors, these 6 things that every manager should know in a company. So if you're selling the business, these are the points you want to get across. If you want to be successful in the business, you have to be aware of these 6 points. And they sound pretty common sense, but it's amazing how often when I talk to owners of companies, their accounting system doesn't have the information, they don't really know the breakdowns of the figures properly, and they really can't get me the results. So I say to them, which are your most profitable products or services? How much can you hone in on that? Who are your most profitable customers? First of all, maybe it's the type of customer, are they commercial, residential, industrial? Can you list some of them? And one of the things to be aware of is if you have one customer that's, say, more than 15% of your sales, that's not an advantage. That's a disadvantage, because what's going to happen is that customer is going to be, well, the business is going to be too reliant on that customer, so you really have to be more focused and make sure you don't have one predominant customer, because that will discourage other people. And you need to know what the expense drivers for those customers are. Is it internet support? Is it technical support? Is it calling on them? What is it that's going to be the expenses that you have to incur to keep those customers happy? A fourth area that's very important is how do we keep control of cash flow? More businesses go broke because of cash flow problems than anything else. It's not a lack of profits, it's a lack of cash flow. That's what gets us into big trouble. So we really need to get our cash flow under control and show that we're managing it properly. And when we talk about the corporate structure, you'll see a little bit more about managing cash flow and taking excess cash flow out of the business. Now, this is a really important part of our business that we need to be focusing on. So I'm going to spend a couple of minutes on this, and that is, what are the critical success factors in your business to make your business successful? Well, managing cash flow could be one. The amount of profit you make would be another. And an easy one to look at is the amount of sales. So if you said to me, our critical success factor in sales is to do $3 million a year in sales, I'd say, okay, that's a critical success factor. But that's an outcome. That's not an activity. That's an outcome as a result of a whole lot of activities. And the activities are called key performance indicators. So what are the key performance indicators? So, for example, as I said, if we're going to do $3 million in sales, I'd say, okay, well, one of the things we need to know is how much work do we have on hand? So we would set a key performance indicator that might be 10 or 15% of a year's sales, that's the amount we need to have on hand. So if you said to me, yeah, we need to have 10% of a year's sales on hand, that means all the time we would need to have $300,000 of work on hand. If we don't have that, then we're unlikely to reach our target. If we have a lot more than that, maybe we're going to exceed the target. Another one might be, how many quotes have we got outstanding, and what's the average value of the quotes? So if we have 50 quotes out and the average value is $100,000, then we know what the value of the work that we've quoted that's out there that's still alive. And then another performance indicator would be, what's our conversion rate? Do we convert 1 out of 4, 1 out of 2, 1 out of 10? And those are the sort of performance indicators that you need to establish, and they will tell you whether you're going to reach your critical success factor. So that's really really important management tool that you can use, which will help increase the value of the business. And it will certainly make your business a lot more successful. And as you see there, I said on page 3 on point 5, what are your 3 critical success factors? Let's treat them, and then how do you use your KPIs? So you need to build that up. It's not something we can do today, but it is certainly something you need to build up to make this a lot more successful. But to me, looking at those elements are very critical for positioning your business to be a business that people are going to want to buy. Now, and it's the last point there, I said, you got to measure things, you got to monitor, and you got to manage them, manage the activities. So really, that's what that whole process is about, is you measure, you monitor, and it's manage activities, not the people, manage the activities that the people perform. That's going to get you far better results and is far less confrontational than managing people. So manage activities, manage those key performance indicators, and make them better. And that could be your role. So one of the things you want to do is draw out an organization chart and put your name into the different boxes to show the different things that you do within the business. And this was one of my clients, Dave, and I got him to do that. And when he came back with that, I thought, wow, we got a lot of potential for improvement here. So we made it a policy, free up Dave. That was our job, free Dave. So we started to look at those individual boxes and say, right, what is he doing in that box? Like if we say, right, I'm doing the estimating, well, estimating is a result of a whole lot of different activities. You got to do takeoffs, you got to get material prices, labor factors, a whole lot of elements to estimating. So start breaking them down, putting them into more simple processes, documenting them, because that's how you get out of these jobs. You might not be able to hire somebody to do the estimating, but maybe you can hire somebody to do the takeoffs or to get the material prices or whatever, and start doing it that way. And that leads us to the next process, and that is, what do you do all day? What are the activities that you're doing to make the business successful? And I guess one of the questions I would ask you at this stage is, do you own the business, or does the business own you? Do you own the business, or does the business own you? If the business owns you, you're never going to be able to sell it, you're never going to be able to back off from it, and it's really going to hurt you quite a lot. So you really have to get to the stage where you can say, I'm independent of the business. I don't want you to be like Dave. And Dave said to me, he says, I like the 40-hour week so much that most weeks I do it twice. So that's kind of not the way to be successful in your business. And another way I look at it is I say to you, well, it's okay for you to love your job, but your job doesn't love you. So, you got to get these things into perspective. So what I want you to do is to fire yourself. That's right, fire yourself. Give yourself 90 days notice and say, in 90 days time, I am going to stop doing the day-to-day work in the business. I'm going to go on vacation. I'm going to come in when I want to. I'm going to be big picture guy. So to fire yourself, you need to look at the activities there where I've said to you, what tasks do you undertake each day? You need to document the tasks you do. And then as you do that, you should be looking at which tasks should I delegate? And then look at the next section where it says, how do you go about delegating those tasks? So you really need to start looking at all those things. How are you going to make those things happen? And the important point here is delegation, not abdication. So start to put processes in place. Don't just give it to somebody. You've got to document how you do it and make sure you train somebody else and do it in small steps. And then you can see on the screen there are 3 questions that I want you to ask yourself then every day. Are the decisions I made today based on my exit plan of firing myself? Did all the activities that I did today, did they move the process forward? And the third question then, what can I do better tomorrow? Because I want to make this work. I've only given myself 90 days. So really, how are you going to make that 90-day process work? And we've talked about the delegation, but there's a difference between delegating and abdicating. So that's why I'm reinforcing this concept of putting process in place, doing checklists, making sure you train people to do what you do. Your job is to become a teacher and teach others to do what you do yourself so that you don't have to do it. And I remember one of my clients here in Vancouver a few years ago, he was working too hard, the company was making a lot of money, and he wanted to figure out what to do. So we followed this process and said, well, let's fire you within 90 days. In his case, what we did was he brought in another manager to take on a lot of extra work, and that freed him up. And at that stage, one of the national firms came along, and they offered to buy the company, and they said they'd pay 4 times earnings for the company, and the company was doing very nicely. And I said to the owner of the company, don't sell it. Why would you sell it now if you've got your freedom, you can manage to keep the business and keep your freedom? So we turned them down. A year later, they came back, and they increased their offer by almost 50%. And that's the one he took. So, you know, you can make those changes, and that really makes a huge difference to the bottom line that you're going to get for the business. So after you've fired yourself and you're not working in the day-to-day side of the business, you can actually rehire yourself more as a consultant. And consultants can charge much better rates sometimes, so you can make some serious money doing this sort of thing. So if you're going to be the consultant and the advisor to the business, here's the things I would like you to be looking at. Looking at your A, B, C, D customers. Take your D customers and you either sell them or give them to your competition. And then your competition has twice as many D customers, which means they can't look after their A customers, and their A customers are going to be looking for a new contractor, and you're going to have the capacity to do that. And I reckon it's about maybe a 6 or 7 to 1. If you can get rid of about 7 weak customers, all you need is 1 decent customer to replace them. So start figuring out your A, B, C, D customers and stop dealing with the D customers. Talking about employees, in a lot of cases we talk about the 80-20 rule. 80% of your profits come from 20% of your sales, and 80% of your money is tied up in 20% of your accounts receivable. But with employees, it's not an 80-20 rule. It's a 20-60-20 rule. 20% of your employees are really great. They're your stars. 60%, they're doing fine. They're keeping things running, and they're doing what they're supposed to do. And 20% are very high maintenance. They're subpar, and they're the ones you spend all your time, and everybody spends time looking after them and managing them and making sure that they're doing their job, and they take all the support. That's not a solution. The solution is to fire those 20%. You have to start being a tough business person, get rid of those weak employees, because if you don't, the top 20% feel that they're not being looked after. They're not getting any kudos, they're not getting any support, and they're going to either work for your competition, or worse still, they will set up in competition to you because they're not happy. So you need to be focusing on the top 20% of your employees, not on the bottom 20%. Having the right suppliers is important. Not only do they need to be reliable from a supply point of view, but are they giving you technical support? Are they giving you guidance? Are they giving you materials, marketing materials? Have you got the right suppliers? And get rid of the ones that are not doing enough for you. Another element we need to look at is, are we doing profitable work, or is some of the work unprofitable? And some of your work is usually not making much money, and it's high maintenance, high overhead, just not profitable, or too small a portion of your business. You want to get rid of that. And surprisingly enough, most companies can put up their prices. Particularly companies that do service work, I invariably tell them to put the prices up by $10, $15 an hour, and rarely do I get any negative feedback. You know, there's always somebody that's out there cheaper than you, so the cheap people are not getting all the work. And if you're worth the value that you add, if you're a good contractor, people will pay your prices. So don't be afraid to do that. And one way of helping to do that is by adding value to your services. Maybe by saying to your clients, we'll give you more information, we'll give you budget prices on replacement of equipment, we'll show you how to be more efficient. We might be able to say to you, you know, replacing this equipment will reduce your operating costs. And then lastly, we could look at expanding our services. You know, if we do new construction, should we be doing service work? If we do retrofit, should we be doing service work? Should we be going into the control side of the industry? Should we be buying somebody in a comparable business? If I'm an electrical contractor, should I be buying a HVAC contractor or a refrigeration contractor, something along that line, and doubling up on my customer base and everything? So the reason that these things are important, and sorry, there is one more, keeping your key employees on side, because they're your most important assets. And the reason you need to do all this to be more attractive is because 80% of listed businesses will not sell. So if you want your business to sell, you have to be one of the 20% that people are saying, wow, this is the one I gotta have. So now we're going to get into some of the heavier stuff, and that is a holding company and an operating company. And what does the holding company do? It owns the operating company, and it takes possession of certain assets. And the operating company is the one that has all the day-to-day stuff in it. So there we are with the holding company, and maybe we have two separate operating companies. You might have an electrical, you might have a mechanical. Who owns the holding company? You can own it. A partner could own it. Now, when you sell the shares of a company, you can get over $800,000 tax-free as distinct from selling the assets. If you have two partners, say your partner is not a family member, not related to, they might have their own holding company. So you might each of you have your own holding companies, which could be quite an advantage. So to recap on these points, why have a holding company? Because it protects your assets. It takes them out of the operating company, and it moves your retained earnings, your building, and possibly even your equipment up into this holding company, which is isolated from the operating company. And the owners own the holding company. The holding company owns the operating company. And what should be in the operating company? Just the day-to-day activities, the inventory, the work in hand, the employees, and the operations. And one reason for doing this, which would be very critical for you when you want to sell your business, is if you sell the operating company, it's got a lot less value because a lot of the assets are in the holding company. So for example, if you sell the operating company and the equipment is in the holding company, then you can do a lease to purchase on the equipment. It makes it easier for people to buy into the operating company, particularly if you're selling to family or to employees. That certainly makes it a lot easier like that. So that's probably enough on that corporate structure. You really need to talk to your own accountants and your advisors, because all our situations are different, and we're pretty generic here on the things we're talking about, so I don't really want to go into much detail on that because I really don't know your situation. And as I say, you should be getting independent specialized advice on that. So let's just quickly look at, should I sell assets or should I sell shares? And there's no right or wrong answer. When you get numbers together, you should be talking to your accountants about, well, what's going to be the difference in tax if I sell assets or sell shares? How much less or more am I going to keep by doing one way or the other? And that will help you decide on the value. So often if you sell assets, you might get a bit more money to compensate for the fact that you'll have some more tax to pay. So I like selling assets from the point of view, it's a lot easier to sell assets because the buyer can do a lot less due diligence. They're not taking over the risk from the company. They're not taking over all the skeletons that might be there. They're not taking over liability for past jobs. They're not taking over any exposure to the Canada Revenue Agency. So there's a lot less risk for the buyer. And it also gives you the opportunity of keeping what you want. So if you don't have a holdco, for example, and you have your retained earnings in your operating company, you get to keep those. Or if you've got your own truck in the operating company, you get to keep that. And you get to keep your company, and you can still run expenses through it and run it as a smaller business. The selling of shares, it gets you the tax-free, the over $800,000 tax-free. And, you know, if you, husband and wife team own the business, that's $1.6 million tax-free, which is pretty nice. As I said earlier, the skeletons will go with the sale of shares. So if you sell your shares, you're going to sell the skeletons as well. So that's one of the big issues on that. So I'm going to take you through two little activities. Just take a couple of minutes. They're not in your workbook. They're on the screen, so I hope you have your screen. You can see the screen okay. And I've called it, you know, what manager runs a business without knowing the numbers? So here's two ways of making your business more successful. So for example, and it's amazing how many companies can't get me this information. If I said to you, okay, how many customers have you got? And you say, well, we got 1,500 customers. We're losing about 10% a year. We're replacing about 10% a year. Therefore, we're staying at around 1,500 customers. We deal with each customer once a year. Therefore, we deal 1,500 transactions. Our average sale is $900. Therefore, we're doing $1,350,000 in sales. Our job cost is 65% is $877,500. That means our gross profit, which is the difference between our total sales and job cost, is $472,500. If our overhead is 30%, we're making 5% pre-tax profit. So if you're now the consultant to the business, because after the 90 days you fired yourself, and you start to put processes in place, and you say, okay, well, let's put in a better customer retention process. And instead of losing 10% customers, let's say you only lost 5%. And let's say instead of adding 10%, you added 12%. Not huge changes, but the number of customers go up by 1,605 from 1,500. And now let's say you were able to get a quarter of those customers to buy from you twice a year instead of once a year. Now your number of transactions have gone from 1,500 to just over 2,000. So you're able to increase the average sale from $900 to $950 by adding on an extra product. You might be, if you're selling mechanical systems or something, maybe you can sell a thermostat. I depend on what segment of the industry is, but there's probably things you can sell to customers. And look what's happened to our sales figure. It's gone from $1,350,000 to over $1,900,000. Now, if I were to put up my selling price by 2% and become 2% more efficient in my job costs, my gross profit would jump from 35% up to 39%, would be $743,000 compared to $472,000. And if it cost me $100,000 more in management time and in system, the training and everything to do this, my overhead would increase by $100,000 to $505,000. But look what's happened to our profit. It's gone from $67,000 a year to $238,000. So every year that I have the business, I'm making an extra $168,000, and I've increased the value of the business, if I'm using a 3 times multiplier, by more than $500,000, but just by making those small changes. So that's one of the reasons why it would be good to do that. So another way of looking at the business is if you don't have much time, you think, well, you know, I only have a small business, what's it worth? And here's your business on the left-hand side. I'm doing $750,000 sales. I'm only making 16.7 gross profit. I've only got 10% overhead. I'm making 6% profit. That's $45,000. It's 3 times multiplier. My business is worth $135,000. So now I've got a competitor who's a little bit bigger, doing a little bit better, and he's making $100,000, which is 10%. And on the 3 times multiplier, his business is worth $300,000. Now, if you combine the two businesses, they're not going to be just worth $300,000 plus $135,000. There's going to be economies of scale. There's going to be advantages. And in this case, what I did was I said, okay, well, we're going to take over all the job costs, but we're not going to take over much of the overhead. And as you can see, the business now, instead of being worth $435,000 combined, they're worth $600,000. So if you're the guy selling the smaller business, you know, you might be able to get more than your $135,000 by going to a competitor and saying, look, at the advantage of combining the two businesses. It's a strategic buy-in, and the strategic buyer will pay more than somebody off the street. So that was one of the good points I wanted to look at there. And the last thing we want to talk about is your call to action. So honestly, if you just go away from this and take the time off and don't write down a few things that you want to do to make your business more successful, you're going to put this in the back burner and you're not going to make the progress you want. So I really encourage you at this stage to write down 2 or 3 things. Go back over the little workbook and make some comments and make some changes, and don't suffer from that dreaded failure to implement disease. So just remember, you want to sell your business and buy your freedom. Thank you very much. Back to you, Anthony.
Excellent. Thank you very much, Ron. I've collected a couple questions during your presentation, but I think I'll start with one that you sort of ended with, but you also mentioned at the beginning in terms of some owners overvaluing their businesses. So someone asks, just how easy is it to get a valuation on my business?
Okay, well, you're not going to get a one valuation figure. Usually what a evaluator will do is say it's be worth between A and B. So as a fairly simple rule of thumb, and this is dependent on, a lot on the segment of the industry you're in. The first thing you do is, let's say we're doing an asset sale. You do, what's the market value of the assets? So obviously that's the first figure. And then you say, okay, well, what profit am I making? We do a thing called EBITDA, E-B-I-T-D-A. What are the normal earnings of the business before interest, before tax, and before depreciation or amortization? And to me, then, that's what I call the goodwill value of the business. And the answer to that figure is probably anywhere from 1 to 4 times. A decent trade contractor making about 7 or 8% pre-tax profit should be getting about 3 times his goodwill value, his profit for the goodwill, plus the asset value, and then he would be keeping the cash flow that's in the company. So that's a kind of a rough guideline. Usually a valuation will cost you around $3,000. There are registered evaluators that can do that. I've done them for a number of clients. I'm not a certified evaluator, but you know, obviously I understand the construction industry. But that's about what it's going to cost you to do that. But that's a kind of a rough figure. I hope that helps.
No, very good, very good. And now another one of our audience members asks that, you know, how would you advise someone who wants to sell with 6 months compared to someone who won't be selling for 5 or more years? So maybe some of the differences there.
Well, if you're going to sell fairly quickly, the most important thing to do is to work your way out of a job. You have to be able to start delegating, because the problem is, if, you know, have you bought a business or have you got a job? And if the business is reliant on you, you're not going to be able to sell it. So you really have to start in the short term figuring out how to get yourself out. So really that 90-day firing is critical if you're looking at maybe a 6-month exit. If you're looking at a 5-year exit, maybe you take a more balanced approach and say, okay, I'll start gradually working my way out, and at the same time I'll start making the business more attractive. I can spread my work out more. Either way, you have to become a teacher. But I guess if you're got 6 months, you're going on a crash course, and you've got to be far more aggressive, and you've got to be a lot tougher and a lot more focused, and get hands off very, very quickly. Does that help?
Well, I guess we'll find out eventually when the questionnaire gets sent around. Now, another question sort of dovetails off of this one. You had mentioned firing yourself as being the most important thing, especially if you're trying to do it within 6 months. So I guess that would be the first thing of, if you had to pick top 3 things in your business to get it ready. So the top 3 things that you need to work on, you know, right away to get exit ready. What would those 3 things be, assuming that, you know, firing yourself is the first?
Okay, so the next thing I'd want to look at is, I said there's 6 critical factors. You really need to fine-tune what are the values in the company. The profitable products and service, our good customers, the expense drivers. Those elements that we talked about. Getting those correct is really essential. So that would certainly be one thing to do, and put more processes in place. And the other 2 things I would want to get definitely, and this is the hardest thing to do, is get rid of some of the weaker employees, because they have to be gotten out, and also get rid of some of the high maintenance customers. And one of the things to watch for, and we didn't cover this off, but it's a critical one to watch for, and that is when you're selling your business, if you've got long-term employees, you could be open to serious severance packages. So you really want to take into account, are you exposed to serious severance packages? So that would be another thing I'd want to look at very quickly and see if I'm exposed there.
Oh, very good. Now, you had mentioned in your presentation, refer to your own accountants or professionals to help guide through in your specific business, specific situation through these things. Now, what about business brokers? We've heard about business brokers. How do you go about choosing one of those? Are they any help?
Yeah, they're kind of like realtors. There's a lot of them around. The biggest issue you want to do is, first of all, you want to find out if they understand your industry. Most of them don't specialize. I mean, I only do construction companies. They'll do a cross section of businesses. So, if you're an electrical contractor, you want to, well, have you sold any electrical contractors recently? Can I talk to the people, see how it worked for them? And so that's important. Is like anybody else, you want to get a reference on them if they understand your industry. Do they have any contacts in your industry? And their fee structures, some of them want huge sums of money up front. Some of them want fairly significant percentages. There's no sort of standard industry. It's not a regulated industry. And that's one of the concerns people have, is there are no regulations. It's a bit like financial planners. Anybody can put out the shingle, and so therefore there's a huge amount of buyer beware in those sort of circumstances. What I would do first is, if I was trying to sell my business, the first thing I would do for finding a buyer is I would talk to some of my suppliers and say, look, we're getting close to retirement. Do you know anybody that might be interested in buying the business? Because if you have a valuation, and if your suppliers and they know all your competitors, and they know who might be interested in buying or who's interested in selling. So I think that's a good way to go about it initially without hiring an external advisor. Also, your association, you can put the word out in your association. You can either do it anonymously through your accountant and give your accountant a list of all the association members and say, send out a letter to all these people saying, here's the profile of a company for sale. So there are some options. It's very hard to get a business broker to deal with the smaller companies because there's a lot of work involved in selling a company. And if your company is only going to be worth $300,000 or $400,000, they're not going to be terribly excited about working for you. So that kind of makes it a bit more of a tough challenge as well. So I think they were kind of the key points I'd want to make on that.
Very good. And oh, that was your screen. Okay, sorry about that, Ron. I have one more question that actually comes from me directly, Ron, and that's because I know you, I know your material, I know your books. You had mentioned in your presentation the possibility of seeing a business continue on in the family, so that after you retire or what have you, the business goes to certain family members. Are there any tips or tricks to ensuring that trying to keep a business in a family actually works out successfully and the family doesn't start hating each other over this business?
Mm-hmm. Yeah, that's a really valid point, Anthony. There's a number of issues. The first issue is there a family member who can actually run the business? There's a huge difference between the number one person in an organization and the number two person, and often we don't see that difference easily until the number 2 person takes over the helm, and that can be a bit of a problem because so you need to get somebody to evaluate the strengths of the family member that's going to be taking over to make sure that they are going to be successful in the business. But the key issue here then becomes this is part of your estate planning. If you don't do proper estate planning, you're going to end up with family members fighting with each other, and it's a tragedy how often this happens, that people start to fight over the money, and your legacy, instead of leaving a nice estate behind, you leave you know, families arguing over so many things. It's not right. So you want to make sure that whatever value is in the business, that if the person in the family is getting that for free, that they understand that that's their portion of their inheritance. That, for example, if the estate is worth $4 million and the business is worth $1 million, well, that's their $1 million out of the inheritance. So that's probably a good way to look at it. And to talk about the other family members with it so that people will all understand and that there's no surprises.